Hey everyone, Aaron Filbeck here at Chi Association, Global Head of Content Strategy, and I'm joined today by Tim Koller, who is a partner at McKinsey & Company and a leader of their strategy and corporate finance practice. Tim, thanks so much for having a conversation today.
Thanks, Aaron. I'm looking forward to it.
Great. Well, we've got a lot to talk about it, and you've authored this valuation Bible, if you will, over several years. And each time you do one of these updates, you're covering some new material, some new content that comes in, usually based on some economic backdrop or what's going on in the world. And I thought we could focus in a little bit more on the special situations segment of this book, just given our audience, which is much more focused on private markets. We have people sitting on the LP side, on the GP side, and so on. And one of the themes that we've really been focusing on here at Kaya is this whole convergence of public and private. We were talking about this in preparation, but we no longer kind of have a binary market in terms of public markets, private markets, and that's at the actual capital formation level. And increasingly, it's at the product structure level as well. We've got a lot of strategies that are incorporating both into their different offerings. So how do you see this convergence affecting the valuation discipline, and in particular, GPs from one perspective that are investing across both public and private, and then LPs who are maybe historically focused on funds, and now they're bringing it in-house and doing it themselves on directs, co-investments, and so on. So a lot in that question, but I'd love your thoughts on just kind of this broader convergence theme.
Yeah, I think when it comes to GPs, I think the better GPs were already doing a lot of the things that we would advocate in our book, right? So, a focus on discounted cash flows, which is driven by growth and return on capital. That's been the foundation of valuation for many decades, right? And nothing really has changed there. And I think that, like I said, the better GPs have always looked at, okay, so what's a baseline set of cash flows for a company, and what can we do to make it worth more, right? So what is the incremental value that we add? So I think there's really no change there, right? I think LPs probably need to get a little more sophisticated if they're going to be involved more directly, either taking direct stakes through the GPs that they work with, or investing, more directly even than that. They're going to need the talent to be able to dig deeper into analyzing these companies, right? And what can they do to make them worth more? Because it's always a matter of, how do you, if you buy a business, how do you make it worth more than what you paid for it? And it's unlikely, if you're an LP in particular, that you're going to get a bargain, right? Bargains are rare. So you have to create value. You have to improve the return on capital. You have to improve the growth of the business. And so I don't think that there's any fundamental differences, right? And I think it's most important to use the valuation techniques to understand the changes in valuation as much as trying to come up with a single number, right? Now, if you're going to buy something, you have to have a single number. When you exit, you're going to negotiate a price. But the key, I think, is often, how can I make this business worth 30 or 40 or 50% more than it was under its prior ownership?
So Tim, you mentioned exits, which I think is an important consideration, especially now, maybe 10, 15 years ago, 20 years ago, it was maybe more of a linear conversation where you're buying a business in the private markets, and then there's an exit at some point. And typically that was through an IPO or through the public markets. Now, obviously you have strategic buyers that are coming in and buying some of these businesses after a number of years, but it seems like the optionality is much wider and obviously market dependent, what's going on in the market backdrop. And we've seen the IPO market accelerate and then decelerate. The number of strategic buyers accelerate, decelerate. So how do you, whether you're a GP or you're an LP, how do you kind of factor that into the modeling process of valuation in terms of that optionality when you're trying to take a long-term view, but some of that is dependent on what's going on at that current part of the cycle.
Right. And that's why, once again, I think the only thing you can really do is focus on the fundamentals, right? You cannot predict, what the IPO market's going to be like in 5 years. You cannot predict what strategic buyers might be interested or not in 5 years, right? So, the way you create optionality is by giving yourself some time frame flexibility. But once again, if you focus on the fundamentals of improving the business, that in itself creates optionality. You will have a more attractive business if you want to do an IPO, or it'll be more attractive to a strategic buyer. Even in sort of slow times, there are IPO transactions and there are sell side and there are strategic buyers. So, the key is making yourself attractive in those circumstances. Once again, it goes back to just focusing on the fundamentals. You can't, no one can predict what's going to be going on with those markets, even next year.
So speaking of fundamentals, and this gets into the actual, maybe some of the themes that you were talking about in this new edition. We've had this growth of AI and technology and disruption, maybe the big fundamental underlying driver. And so as you've talked through kind of the valuation frameworks and methodologies across different stages of a company's life cycle, so venture to growth, buyout, other special situations. And when you think about some of the changes that we've seen on the technology front, or even the geopolitical front, which I know is much more macro, but it does have a more micro impact. How have these frameworks evolved? And maybe back to your earlier comments, how have they stayed the same in an environment like this?
Yeah. Well, let's take the case first of a company that might be using AI as opposed to a company that's selling an AI product, right? For the most part, it's just like any other technology improvement, right? AI allows you to maybe reduce your manufacturing costs. It allows you to provide better customer service. It might help you to do a better job of figuring out what products to design to, that are going to be most appealing to your customers, et cetera. So ultimately, for companies that make things and sell services like that, it's no different than any other innovation, right? The question is, once again, how does it improve your cash flows? The thing to be careful about, though, is that oftentimes your competitors are doing the same thing you're doing, right? So in a sense, in many industries, the value of all these improvements is going to be passed on to the consumer in terms of better products, better services, maybe lower prices. And you got to think about how much of it can I capture? I can only capture the benefits typically if I'm doing something different than my peers and I'm way ahead of them, or if I have some other competitive advantage that I can exploit by using these things. So I think it is important to be very cautious about, it's not that you don't have to do these things. You have to do them, otherwise you'll be left behind. But you can't assume that it's necessarily going to increase your profits or cash flows, because you end up giving away a lot of it. Example I like to use is the technologies that's been changing in the banking world, right? You go back, companies, banks, introduced ATMs in the 80s, early 2000s. There was online banking. Now everyone has a mobile banking app. Has the banking industry become more profitable as a result of that? No. It's become the price of doing business, right? And it'll be the same thing when banks adopt AI. It's going to be the price of doing business. There's competition still, and competition sort of takes that away. You have to do it. You have to do it well. It's not necessarily going to increase your value. When it comes to companies that are selling AI products, I think there's still a lot of uncertainty. We need to figure out what the actual business model is going to be for some of these. Some of these is straightforward. They're going to be selling software to companies or individuals that, just like any other software company, right? The question is, there's a lot of uncertainty about the size, market share, how competitive the markets will be. So you got to look forward. You can't look at historical financials because there aren't any, right? So what we try to do is we try to look forward and say what's a range of reasonable outcomes, 10 years from now in terms of the size of the market share, margins, et cetera, and then work backwards. But we try not to come up with a single number. We try to focus on, what's a range and what should companies do to maximize that value.
So Tim, I love that comment on what accrues to the actual company versus maybe society is kind of the way to think about that. And I think about that a lot on AI because there's a lot of hype around this, and clearly you go through some of these boom bust cycles where, especially in the public markets, if you slap AI on your name or whatever, you get this pop in terms of value. But to your point, some of this doesn't actually benefit the company itself. It's more of a broader kind of societal benefit. So maybe a bit of a tangent that leads to my question, but are there any historical analogs besides banking that you could speak to in terms of how we make those assumptions of a percentage of the benefit to an industry or a sector versus just this is better for the consumer at the end of the day?
Well, another example, and it doesn't have much to do with technology, is the automobile industry. And if you look at it over the last, 50 years or so, the cars we drive today are even sort of economy, so-called economy cars, right? They are safer, they handle better, they are more luxurious, they have more features, and yet they don't cost that much more. And the auto companies don't make more money off of them because it's such a competitive market, right? Every country wants to protect their auto industry, right? In the US, we first had the Japanese coming in, then we had the Koreans coming in. Markets become more fragmented. We have new startups in the electric world competing against established companies in the electric world. So all the innovation tends to be given to the consumer in that industry. And you see it in a lot of industries, even in business to business, like, chemical industry, productivity improvements get passed on right away to the customers, right? Whoever you're selling these petrochemicals to or whatever, because of competition. So most industries behave that way to a large extent, right? There are some exceptions. The best way to sort of create a value, a distinctive advantage, is if people are willing to pay for your brand, where cost is not really relevant. So luxury goods and things like that. Or some consumer packaged goods, where if you can do things, you might be able to maintain your price and keep the benefit. But in a lot of cases, probably the vast majority of cases, the consumer is the ultimate beneficiary.
So Tim, the brand comment I think is interesting as well, because especially when you go earlier stage. So you're talking more venture and maybe less defined industries, less defined companies, you're relying a lot more on narrative and qualitative assessment versus quantitative. If you're in the buyout space, you're buying a company with a long-term operating history, financial statements that you can look at. That's not always the case when you go earlier stage and looking at some of those opportunities. So how do you kind of balance those two as you start to move down that curve, if you will, and do some of the more traditional DCF type of approaches still apply, or is there a different way that you would recommend investors look at this moving forward?
Yeah, I think that one of the things that we do is to sort of look at it the other way, where we say, what would you have to believe to achieve a certain valuation? So if you have a company and it's worth 100 billion, 500 billion, $1 trillion, ultimately, that company's value 5 or 10 years down the road is going to, as it matures, is going to be a function of its, its revenues, its profits, its cash flows, right? So what you can do is you can ask the question, what would I have to believe 5 or 10 years down the road? And then see whether that is within the realm of reasonableness, right? If you're going to believe, if in order to justify the valuation, you have to believe the company in a narrow market is going to be generating 500 billion of revenues at a 50% margin, and it's going to be competitive, you got to question that. Or if you look at semiconductors, even right now, with all the, there's so much competition, and the history of the semiconductor world, right, is one of, fierce competition, cyclicality. Eventually people catch up. So companies that have the lead right now may not have the lead in 5 years, right? So you have to be careful about assuming that a company that is the leader in an industry right now is still going to be the leader in 5 or 10 years, and that competition is going to allow the same kind of margins even if it's not the leader. So that's one of the things that we do, is just sort of reverse engineer things to sort of say, what would you have to believe? And that's, so you're still using DCF in a way. You're still looking at the fundamentals, but you're looking at it from the perspective of what you have to believe is a good tool that we use oftentimes. The other thing that I've learned is, this is sort of a little bit off topic, but it does help, particularly when it comes to public markets. 40 years ago or so, I didn't think the markets could make big mistakes, right? And now I do. Okay. Not all the time, and not for most companies at any time. But we've had, the dot-com bubble and stuff like that. We have a situation now where 7 companies dominate the S&P 500, right? And what I've discovered, and so the question is, and usually like in, 1999, 2000, these bubbles burst, right? They always do. So the question is, why does this happen, right? And, looking at it, one of the things we discovered is that there's sort of a cycle that creates these bubbles, right? That is not counteracted. One of the elements is, first of all, retail investors flooding in to buy a stock, okay? If you look at the top 7 companies right now, sometimes people call them the mega 7 or whatever, the percentage of retail investors is double the rest of the S&P 500, okay? So you have a situation where retail, and how much analysis do retail investors do? They don't do any number crunching, right? They just say, oh, this is a good company. People are excited about it. The stock price is going to keep going up. So they just buy, right?
They're not reading all editions of your book.
Exactly. They're not even doing the basics, okay? Secondly, you then have trading-oriented investors who are sort of betting on the retail investor psychology, right? Even if I think the stock is overvalued, I'm still going to buy it because it's going to keep going up, and then I can get out before it crashes too far and still make money, right? And then I found that you've also got more traditional pension funds and mutual funds who feel that at the end of the quarter, they have to have those stocks in their portfolio. Otherwise, it'll look like, even if they don't believe it, but they'll have to have those stocks in their portfolio. So you have all these forces pushing up the stock price and nothing to counteract that, because short selling is the only way to counteract that. Short selling is very risky, and it's expensive, and there's just not enough potential short selling to keep the share price maybe something more reasonable. And as a result, you do get these bubbles that last for a while. And eventually they will burst, right? And you see the same thing in the private markets from time to time, right? People get, which you expect to be less of an issue. But, you do see people get really excited about a particular new industry or particular company, or there's 1 or 2 private investors, venture capital funds, who are willing to pay, enormous amounts, sometimes the more naive ones. So you can see it with prices that get too high sometimes in the private markets as well.
Yeah. And I want to go back to one of the first comments you made, which is this, it's not about getting the number right as much as it is the direction to some degree. And maybe tie that with your comments there, like, what is the market telling me, and do I agree with it? Or what do I have to believe in order to get there? Which I think is a good way to look at things. It's hard to kind of get to a science of like, well, this is worth X, because it's always changing based on your different assumptions. So I think that leads into my next question, which is, especially for investors who are new in the private market, so maybe LPs that are doing the direct co-investing for the first time, there's not a lot of information that's out there. So it's hard to develop a belief based on what is already in existence, because in some cases there's not market comparables, there's limited transparency into the companies. So how do you kind of navigate that in terms of those complexities when you don't have much to go on at the end of the day?
Yeah. I guess I would argue, though, that if I was investing directly, I was an institutional investor. If I didn't have the same transparency that I get with the listed company, I wouldn't buy it. Because then you're essentially relying on someone else to make those decisions for you, unless you really trust them, right? And from what I've seen, some of the better institutional investors have now built up very sophisticated teams of people who analyze these kinds of investments. And I'm pretty positive that they're not going to analyze, or they're not going to go with something that is where they don't feel that they know enough about the business that they're investing in. So once again, you have this dichotomy between the most sophisticated institutional investors who are doing this, right? And then institutional investors who want to do this, but they're not willing to make the investment. And so they're going to be getting the ones that are sold to them, right? Without, that kind of interaction. Maybe they don't want to build up the teams necessary to do the work. If you're not willing to do the teams necessary to do the work, you probably shouldn't be doing that.
So beyond that, this is my final question for you, but maybe ending where we started, which is this convergence, the funds and direct, the public and private. So you mentioned team sophistication and making sure that you've actually got people who understand this stuff. For people who are in this kind of journey of doing it themselves or looking at these new structures that are available, any common pitfalls or things that newcomers should look out for before they start to move into doing it themselves?
I think the common pitfall is, one, not investing enough in the team, not paying the team enough to be able to get the top talent. I think that's a big issue. And I think the other piece of advice is, be careful about things that are being shopped around, right? So, if you're gonna co-invest, you want to co-invest with a private equity firm that you've had a long-term relationship with, and there's trust built up, right? And they have an incentive to make sure that it doesn't go bad for you because they've got the same thing, those kind of things. So I think it's just, one, making a big enough investment to be able to do it yourself. And secondly, choosing your partners very carefully.
Got it. Well, Tim, maybe talk a little bit about the book. This is the 8th edition. What's new? Why did you decide an 8th edition was necessary on this evergreen topic of valuation?
Yeah, well, this is the 8th edition, so it's 35 years. And well, first of all, what we find is that people like to have new examples and have all the analyses updated to something more current, right? So that's part of it. And then part of it is just figuring out, what's going on in the world that we should be talking about, right? So we have a full chapter now on digital or technology that would include AI, et cetera. We have a whole chapter on sustainability, how to think about that as a company in terms of valuation. We put in chapters on private equity and venture capital, high growth companies. We've always had there, but we've amplified that chapter, et cetera. So, we want to keep it current in light of what's going on in the world. The fundamentals don't change at all. But readers do like to have the latest edition, and it's always impresses me that people do buy multiple editions, right? So we do try to keep it up to date, and we're really excited at the reception of all the editions and the latest edition as well.
Well, great. Well, Tim, I appreciate your sharing some insights and sharing more a little bit about the book as well. Always a pleasure. And for those who have not read or checked out the book, I would encourage you to. But looking forward to doing this again sometime soon.
Thank you, Aaron. Look forward to it as well. Have a good day.